Hello, welcome to Module 9, Analysis of Financial Statements. In this module, we're going to talk about financial statement analysis. How can an investor or any interested party analyze a company's financial statements to find out how well they're doing? Let me repeat that. How can an interested party analyze a company's financial statements to find out how well the company is doing? What tools, what techniques can an interested party use? Well, there are a lot of them, but the most important technique is called ratio analysis. This module is also important because it lays the foundation for the concepts you'll be studying in your next course, Financial Management with Dr. Kudiba. So, let's talk ratio analysis. What is ratio analysis? Ratio analysis enables you to compare a company's performance and see if the company is doing better. Is it better off or worse off than in the past? So, in summary, it enables you to evaluate a company's performance over time. So that's an example of a longitudinal analysis. There's also a cross analysis because it also enables you to compare a firm's performance relative to its competitors. So you evaluate how a company is doing over time, and you can also evaluate how a company is doing relative to competitors. So ratio analysis is very important. In ratio analysis, we examine 4 important criteria: profitability. This examines management's overall effectiveness. Liquidity. This measures the ability of the company to meet cash obligations and pay off short-term debt. Activity. This basically examines how effectively is the company using its resources. Leverage. This relates to the ability of the company to pay off long-term debt and survive in the long term. All 4 criteria are important. Profitability, how well are they doing overall? How well is the manager managing the business? Liquidity, are they generating enough cash to pay off their bills? Activity, are they using their assets effectively? Leverage, can they survive in the long term? For you to decide to invest in a company, it's got to meet all 4 criteria. Could you have a situation where a company is profitable, where they seem to have enough cash, but in the long term they go bankrupt? Of course. So that's why it's very important to examine, as I said, all 4 criteria. So let's get our hands dirty. Let's start with your first ratio analysis. In front of you are 2 companies. I have given you an income statement for 2 companies, A and B. As you can see, for company A, the bottom line profit is 125,000, and for company B, the bottom line profit, that sales revenue after you knock off your expenses, is 170,000. There's also asset information from the balance sheet giving you the company's average assets. The average assets for company A is $1 million, and the average assets, that's plant and machinery, for company B is 1,700,000. Now here's what I want you to do. I want you to eyeball the data. Then I want you to record which company you think is doing better. Stop this recording now. Once you're done with this analysis, you can proceed. Now, let's start. What was your conclusion? You can see that company B is larger and has more profit. Company A is smaller and has lower profit. Did you go with company B? Do you feel company B is doing better? If so, you may not be correct. To figure out overall performance, you use a ratio called return on assets, or ROA. This is net income. Here you go, here both companies. ROA is net income divided by average assets. If you remember, the net income for both companies, 125,000 for A and 170,000 for B. As I said, return on asset is net income divided by average assets. So what are these average assets? I gave the information to you. Company A, 1 million. Company B, 1.7 million. Now, what's the return on assets? It's net income divided by average assets. That's the formula. Write this down. Return on assets, ROA, equals net income divided by average assets. And when you compute it, you get 12.5% for A and 10% for B. What do you conclude? Overall, A is getting a return of 12.5% on their investment in assets. B is generating a return of 10% on their return on assets. So overall, A is managing more effectively than B. A is doing a better job overall than B. Now the next question is, why? There are 2 broad reasons a company could be performing better. To measure overall management effectiveness, you ask 2 questions. One, are they controlling costs? And are they using assets, their resources, effectively? So, if a company is doing bad, it could be because they're not controlling costs, or it could be that they are not using their assets effectively. So this is what we're trying to find out. There's a ratio for measuring whether they're doing a good job controlling costs, and there's a ratio for measuring whether they're using their assets effectively. Are they controlling costs? This is measured by a ratio called profit margin. Are they using their assets effectively? This is measured by a ratio called asset turnover. Let's do the formulas. The formula for profit margin is net income over sales. The formula for asset turnover is sales over average assets. So, I want you to write this down. They're important formulae. Now, I want you to do a small exercise for me. I want you to compute these ratios for company A and company B and tell me who's doing a better job controlling costs and who's doing a better job using assets. Stop this recording now and do this exercise. When you're done, start again. Are you done? Did you get these answers? Compare this with the answers you got. I'm just using the formulae. Overall, if you look at the screen in front of you, company A has a profit margin of 15.6%. What does this mean? This means that for every dollar of sales, A gets to keep 15.5 cents. Company B has a profit margin of 29.5%. What does that mean? This means that for every dollar of sales, they get to keep almost 30 cents. The reason is they're doing a better job controlling costs. Generally, the higher the profit margin, the better the job the company is doing controlling costs. The lower the profit margin, the worse the job the company is doing with respect to controlling costs. So the higher the better. Overall, B is doing a better job controlling costs. So why is their overall performance lower than A's? If you look at asset turnover, A is 0.8. What does this mean? This means that every dollar of asset generates 80 cents worth of sales. For B, it's 0.33. This means for B, every dollar of asset generates 33 cents of sales. Who's using assets more effectively? Obviously, A is. So A is doing a better job using assets. B is doing a better job controlling costs. To put these together and to find out overall performance, you can also use what's called the DuPont formula. Guess what? It's called the DuPont formula because it was invented by an accountant in DuPont in the 1920s. The DuPont formula says return on assets equals profit margin times asset turnover. Can you try it? For A, it's 12.5%. B, it's 10%. Do the numbers sound familiar? Of course it does, because you already computed it before. This is another way of computing return on assets. So, your final conclusion is that overall A is doing better simply because they're using their assets far more efficiently than B. Now, we're going to use the problem on the next slide to understand and compute most of the ratios. Here's the problem. I've given you the income statement for a hypothetical company called Jackville for years 2004 and 2003. As you can see, the sales 2004 was 600,000, 2003 520,000. The total expenses, when you add them up, for A 561,000. When you deduct it from the sales, you get a bottom line profit or net income 2004 39,000. 2003, the total expenses were 488,800. Knock it off from the revenue of 520 and you get their bottom line profit for 2003 of 31.2. Print this out. And I also want you to print out the balance sheet, which I'm going to show you now. I hope it comes out clearly when you print it out. Let me go through the key numbers. The total current assets, 215,000, 2004, 177,000, 2003. Total assets, 638,000, 2004, 560,000, 2003. It's supposed to align. So, for example, if you go to current liabilities, accounts payable were 112,000, 2004, 110,000, 2003. The total current liabilities, 2004, 135,000, 2003, 130,000. And so on. So you can see this for yourselves. I want you to print this out. And when you're done, I want you to look at these questions. There you go. I want you to compute the following ratios for 2004. I'm going to explain the concepts using this problem as an example. So if you want, stop this recording now and print out the income statement, the balance sheet, and the question you have in front of you. This is what we're going to use for the rest of this module. I have an exercise for you. Once you print out the problem, I want you to do parts E, which is profit margin, F, which is asset turnover, and G, which is return on assets for Jackville Company. So figure out profit margin, asset turnover, and return on assets, and do this for the year 2004. Stop this recording and compute it. I'll give you the answers when we restart. Are you done? The answers are for Part E, profit margin, it's 39,000 divided by 600,000, 6.5%. F, now it's tricky. Sales is 600,000, but the denominator is average assets. How do you get average? You had, for 2004, the beginning assets plus the ending assets divide by 2. How do you get the beginning assets? What they had on the last day of 2003 is what they have on the first day of 2004. That's 560,000. At the end, it was 638,000. So the average for the year 2004 is 560,000 plus 638,000 divided by 2. When you compute it, you get the ratio of 1. G, return on assets, is 39,000 divided by average assets, which I just told you, 638,000 plus 560,000 divided by 2, 10.8%. So the answers are E, 6.5%, F, 1, G, 10.8%. Now, are these good or bad? The answer is you don't know. You got to compare it with past performance to see if it's improving, and you also got to compare it with their competitors to see if this is in line with what their competitors are doing or if it's better or worse. So numbers by itself don't tell you much. You got to compare it with past performance, and you got to compare it with what their competitors' numbers are. That's how investment analysts make decisions in the real world. Now, a company is also measured in terms of liquidity. Liquidity ratios measure a company's ability to pay off its creditors. What will happen if a company cannot pay off its creditors? It will surely go bankrupt. The irony is that a company can appear profitable but have major cash flow problems. That's why the liquidity ratios are so important. Have a look at this diagram in front of you. To measure liquidity, you compare current assets against current liabilities. And common sense dictates that current assets should be greater than current liabilities. Your assets should be greater than your liabilities if you want to survive. So let me recap. Liquidity ratios measure a company's ability to meet its short-term obligations. Liquidity is measured by two ratios. What are these? They are the current ratio and the quick or acid test ratio. The current ratio is measured as current assets divided by current liabilities. Generally, the higher the ratio, the more liquid the company. This is a ratio that loan officers are very interested in. When a loan officer examines current ratio and the loan officer concludes that it's not very healthy, guess what? They are not going to give you a loan, because their attitude is, hey, if you can't pay off your existing creditors, how can you pay us off if we give you a loan? Guess what a company has a tendency to do if their current ratio is low? Don't get shocked. Company accountants tend to cheat or manipulate. They manipulate so the current ratio looks healthy. How can they do that? Most fraud or manipulation, it's a better word, occurs through inventory. If a company's current ratio is low, they generally tend to increase the ratio by inflating inventory. It's very difficult to pick this up. Can a loan officer go to a company and physically check all the company's inventory? Can an auditor do that? It's almost impossible. So to measure liquidity, we have another ratio. Loan officers say, hey, we're smart too. We know you could be cheating through inventory. So they measure liquidity by another ratio, the quick ratio. The quick ratio is measured as follows. All current assets excluding inventory divided by current liabilities. So to summarize, liquidity is measured by two ratios, the current ratio and the quick ratio. Now this is very important. For current ratio, the cutoff is 2. If a company has 2 or over, it passes the test. Obviously, the higher the better. When a loan officer computes the current ratio and it's less than 2, they conclude that the company is going to have cash flow problems, because their research tells them if you operate with a current ratio less than 2, you'll definitely have cash flow problems. For acid test, guess, can you give a guess? What's the cutoff? The cutoff is 1. Generally, they want this ratio to be 1 or over. So, to repeat, the cutoff current ratio is 2, and the cutoff for the quick ratio is 1. But again, the higher the better. Now, I want you to go to the Jackville company and do parts A and B, where they ask you to do the current and acid test ratio. Stop this presentation and do it. Do it for 2004. Compute the current and quick ratios and tell me what's your conclusion about the company's liquidity. Stop this presentation now and try it. Start again when you're done. Are you done? A. Current ratio. The current assets are 215,000 divided by current liabilities, 135,000, and it comes to 1.6. What do you think? It's lousy because it's lower than the cutoff of 2. Would a loan officer give a loan? No. Is there a chance that they'll have cash flow problems? Absolutely. Now, let's try the quick ratio. You add all the current assets excluding inventory. So it's 21,000 plus 18,000 plus 92,000 divided by 135,000, and you get 0.97. What's the cutoff? 1. Have they failed the liquidity test? Yes. So a loan officer would conclude, even if they look healthy, they have cash flow problems. Would you invest in such a company? Maybe not. There are 2 other important aspects to liquidity. When examining liquidity of a company, people also look at 2 issues. First, how well is the company managing its accounts receivable? This is measured by something called the receivable turnover ratio. What does the receivable turnover ratio do? It measures how quickly accounts receivable is converted to cash. Here's the formula. Receivable turnover is sales over average accounts receivable. Okay, let's talk about this a little more. I'm going to repeat. An important aspect of liquidity is how quickly accounts receivable can be converted to cash. The more quickly, the better for your cash. Let me repeat that. When you compute this, the higher the receivable turnover, the faster you're getting paid. That's good for your cash. If the receivable turnover is low, that means you're getting paid very slowly, not fast enough. That's not good for your cash. Now, let's do our first problem in this area. Let's assume sales for a company is 1,200,000. Average accounts receivable is 150,000. I have 2 questions for you. What is the receivable turnover? And how do you know if the performance is good or bad? Think about it for a minute. Well, the receivable turnover is 8. Correct? Just check it out. That means they collect cash from their customers 8 times during the year on average. If it was 10, hypothetically, it means they're getting cash of their customers 10 times during the year, and so on. Okay, in this example, it was 8. Is that good or bad? Answer is, you don't know. What you have to do is also look at a ratio called collection period. Collection period equals 365 divided by receivable turnover ratio. Let me repeat, 365 divided by receivable turnover ratio. Why 365? Because there are 365 days in a year. So let's do it. In this case, it's 365 divided by 8, which is 45.6 days. What does that mean? It means the company takes about 46 days to collect cash from customers from the point of sale. So from the point of sale to the customer to the time they got the cash was 45.5 days. Is that good or bad? Don't know. If you're the boss and you want to find out if your receivable managers are doing a good job, or if your company is doing a good job with respect to getting cash from your customers, what you do is you compute the collection period and then compare with the credit period given to customers, the credit period granted to customers. If the credit period granted is 30 days, and they're taking like 46 days to get the cash, it's very bad because they're taking 16 extra days to get money. However, if the credit period you had assigned is 50 days, then this can be considered good since they're collecting the money within the period. Now, I want you to do part C of Jacksonville Company. Assume the credit period is 30 days. What do you conclude about the way they're managing accounts receivable? So this is part C. Stop this recording, try it, and restart when you're done. Have you tried it? It's tricky, right? What was the formula? Receivable turnover is sales over average accounts receivable. The numerator is easy. It's given to you, 600,000. We're doing it for 2004. So the numerator is 600,000. The denominator, okay, it's average accounts receivable. So it's accounts receivable at the beginning of the year plus accounts receivable at the end of the year divided by 2, which is 92,000 plus 74,000 divided by 2. You get around 7.2, which means they're collecting cash 7.2 times during the year on average from their customers. Good or bad? Compute the collection period and compare with the credit period granted. What do you get? What's your final conclusion? The final conclusion is the credit period is 30 days, but they're taking around 50 days to get cash from their customers. So they're doing a sloppy job. And that may be the reason, part of the reason, they're having cash flow problems, as you found out from the current and quick ratios. The last ratio is called inventory turnover. This is another measure of liquidity. Inventory turnover measures the number of times on average the inventory sold or turned around during the year. If inventory is sold quickly, then it will have a positive effect on your cash flow. On the other hand, if it's stuck in your warehouse, then there are obvious costs and it will have a negative impact on a company's cash flows. So it's very important to find out how well a company is managing its inventory. The formula for inventory turnover is cost of goods sold over average inventory. So, for example, let's say the cost of goods sold is 1,500,000 in a hypothetical example, and the average inventory is 500,000 in a hypothetical example. Spend 2 minutes and tell me the inventory turnover. Then tell me, is it good or bad? So, 2 questions. What is inventory turnover? And how do you know if it's good or bad? Well, the answer is 3. And to find out if it's good or bad, you use another ratio called holding period, which I just put up in front of you. Holding period is 365 because there are 365 days in a year divided by inventory turnover. This comes to 122 days. This means on average, from the time it came to the warehouse to the time it left because you sold it, the time gap was 122 days. Do you want these days to be high or low? As low as possible. You don't want the inventory stuck in your warehouse. So, one more time. From the time the inventory came to the warehouse to the time it left, 122 days. Is that good or bad? Well, it depends. It depends on the industry. For example, if the company is selling expensive jewelry, maybe okay. If it's selling fish and they have crates of fish for 122 days, then maybe it's not so good. So an investment analyst or management consultant would compute this ratio and then compare it to the industry. Can you try part D of Jackville Company? Turn this recording off, try it, tell me the inventory turnover, and then the module is over. So stop this for a few minutes and try it. Are you done? Inventory turnover, answer is 5.4. Cost of goods sold for 2004 is 415,000. Average inventory, the denominator is beginning inventory for 2004 plus ending inventory divided by 2, which is 84,000 plus 70,000 divided by 2, you get 5.4 times. Means inventory was turned around 5.4 times during the year. And you'd also go one step further and compute the holding period, in this case 365 divided by 5.4, and you get the number of days. And to really find out if it's good or bad, you compare with past performance of the company to find out if performance is improving. Ideally, you want the number of days, the holding period, to decline. And you also compare with your competitors. So we're done with Module 9, which deals with the first part of financial statement analysis.